Two ETFs are dominating every dividend investor's watch list right now, and for good reason. SCHD and JEPQ represent two completely different philosophies in the dividend investing world, and the choice between them could fundamentally shape your financial future. On one side, you have SCHD, the steady wealth builder that's been quietly compounding returns for over a decade. On the other, there's JEPQ, the income powerhouse that's been turning heads with its double-digit yields since its launch. But here's the thing that keeps investors up at night. You can't have both strategies in one fund. Your choice could mean the difference between steady wealth building that compounds over decades and maximum income generation that pays your bills today. The eternal dividend dilemma has never been more relevant, and today we're settling this debate once and for all. I'm going to take you through 5 critical categories that will reveal which ETF deserves a place in your portfolio, and by the end of this video, you'll know exactly which one aligns with your financial goals. Before we dive into this epic ETF showdown, hit that like button if you're ready to finally solve the SCHD versus JEPQ debate, and subscribe so you never miss our latest investing breakdowns. Let me introduce you to the contenders. SCHD is like the Warren Buffett of ETFs, absolutely obsessed with quality above everything else. The Schwab U.S. Dividend Equity ETF tracks the Dow Jones U.S. Dividend 100 Index. But here's where it gets interesting. This isn't just any random collection of dividend stocks. SCHD's selection process is ruthless and methodical. Every single company in this fund must have paid dividends consistently for at least 10 years. Think about that for a moment. That means these companies were paying dividends even during the 2008 financial crisis, the dot-com crash, and every market turbulence in between. But the filtering doesn't stop there. Each company must maintain a minimum average daily trading volume of $2 million and have a market cap of at least $500 million. The fund then digs deeper, analyzing 5-year dividend growth rates, annual dividend yields, and return on equity metrics. The final portfolio is capped at 4% per individual stock and 25% per sector, ensuring no single holding can dominate your returns. Currently, SCHD holds 103 stocks with household names like Coca-Cola, Verizon, Cisco Systems, Texas Instruments, and Home Depot leading the charge. Now let's talk about JEPQ, which is the income machine that's been using Wall Street's secret weapon to generate jaw-dropping yields. The J.P. Morgan Nasdaq Equity Premium Income ETF takes a completely different approach. It's actively managed by a team of experienced portfolio managers who are essentially running a sophisticated income-generating operation. Here's the genius behind JEPQ's strategy. Imagine you own a rental property, but instead of renting out the whole house, you're renting out the potential for massive price appreciation while keeping the steady rental income. That's essentially what JEPQ does with stocks. The fund invests in large-cap growth stocks from the Nasdaq 100, companies like Nvidia, Microsoft, Apple, Amazon, Alphabet, and Broadcom, but then sells call options on these positions. When you sell a call option, you're collecting premium income from other investors who are betting these stocks will surge higher. This covered call strategy is what allows JEPQ to pay out an incredible 11.5% dividend yield while still giving you exposure to some of the world's most innovative companies. The fund currently holds 109 stocks and distributes income every single month, making it a favorite among income-focused investors. When it comes to diversification, we're looking at two completely different philosophies, and this difference could significantly impact your portfolio's stability during market turbulence. SCHD spreads its bets across multiple sectors like a Swiss Army knife. You've got consumer defensive stocks, energy companies, healthcare giants, technology firms, and industrial powerhouses all working together. This diversification showed its strength during the fund's yearly reconstitution in March, when SCHD dropped 17 stocks and added 20 new ones, significantly increasing its energy sector exposure while maintaining balance across other sectors. This rebalancing demonstrates the fund's commitment to adapting while maintaining diversification. The beauty of this approach is that when one sector struggles, others can pick up the slack, providing more stable returns over time. JEPQ, on the other hand, is like a precision scalpel focused on one specific area of the market. Since it loosely tracks the NASDAQ 100, it's heavily tilted toward technology and growth stocks. This isn't necessarily a bad thing. These are some of the most innovative and profitable companies in the world. But it does mean your portfolio will be more sensitive to tech sector volatility. When growth stocks are flying high, JEPQ participants along for the ride. But when tech takes a hit, JEPQ feels it more acutely than a diversified fund like SCHD. For this category, SCHD takes the clear victory. While both funds hold roughly the same number of stocks, SCHD's broader sector exposure provides better protection against sector-specific downturns and offers more balanced, long-term growth potential. Now let's dive into the income showdown, because this is where things get really interesting and where your personal financial goals will determine the winner. SCHD's income profile tells a story of steady, reliable growth that compound over time. The fund currently yields 3.9% with quarterly dividend payments, which might seem modest compared to flashier alternatives. But here's where SCHD's true power reveals itself. This ETF has delivered a 5-year compounded dividend growth rate of nearly 11.5%, meaning your income from this fund has been growing by more than 11% every single year for the past 5 years. Even more impressive, SCHD has achieved 13 consecutive years of dividend growth year after year, through bull markets, bear markets, and everything in between. This isn't just about the dividend you receive today, it's about the dividend you'll receive 5, 10, or 20 years from now. The compounding effect of this dividend growth is truly remarkable. If you invested $10,000 in SCHD 10 years ago, not only would your initial investment have grown, but your annual dividend income would be substantially higher today than when you first invested. JEPQ's income profile is designed for investors who need cash flow today, not tomorrow. With an 11.5% dividend yield paid monthly, JEPQ is delivering serious income right now. However, this income comes with important caveats that every investor needs to understand. Monthly distributions have fluctuated between $0.42 and $0.62 over the past year, and this variability isn't a bug. It's a feature of the covered call strategy. When markets are volatile, option premiums increase, leading to higher dividend payments. When markets are calm, premiums decrease, and so do the distributions. This means JEPQ's income is inherently tied to market volatility levels. Additionally, while JEPQ's dividends have increased since inception, this isn't the fund's primary goal, nor should investors expect consistent dividend growth like they would with SCHD. This creates a fascinating dilemma for investors. SCHD offers lower immediate income, but provides growing income over time, while JEPQ offers high immediate income but uncertain growth prospects. For retirees or investors who need maximum income today, JEPQ's 11.5% yield is hard to ignore. For younger investors or those focused on long-term wealth building, SCHD's growing dividend stream might be more valuable. If we're strictly looking at income generation for current needs, JEPQ takes this category, but it's important to understand exactly what you're getting and what you're potentially giving up. Risk and cost analysis reveals some crucial differences that could significantly impact your long-term returns, and this is where SCHD's conservative approach really shines. SCHD operates as a relatively safe and conservative play due to its strategy and holdings. The fund has a 10-year beta of 0.86, meaning it's actually less volatile than the overall market. This lower volatility provides smoother returns over time, which is exactly what dividend investors typically seek. However, SCHD isn't without risks. The fund's top 10 holdings make up roughly 41% of its total weight, which is somewhat concentrated compared to other dividend ETFs like VYM that maintain only 25% in their top holdings. This concentration means that significant moves in SCHD's largest positions can have outsized impacts on the fund's performance. Additionally, SCHD's increased exposure to the energy sector following its March reconstitution makes it more vulnerable during periods when oil demand is affected by geopolitical issues or economic slowdowns. From a cost perspective, SCHD is incredibly efficient with an expense ratio of just 0.06%, costing you only $6 for every $10,000 invested. JEPQ carries different but potentially more significant risks that stem from its strategy and holdings. The fund's heavy exposure to high-growth companies means it's susceptible to the same volatility that affects the broader tech sector. The top 10 holdings represent roughly 45% of the portfolio weight, creating concentration risk in some of the market's most volatile names. While JEPQ does provide some cushion compared to directly owning QQQ or QQQM through its covered call strategy, it's still vulnerable to large price swings and drawdowns when growth stocks fall out of favor. The more significant risk, however, comes from the covered call strategy itself, the underperformance due to capped potential capital appreciation. When you sell call options, you're essentially selling away your upside potential above the strike price. If the underlying stocks surge higher, you don't participate in those gains beyond the strike price. This means that during strong bull markets, JEPQ will underperform a simple buy and hold strategy of the same stocks. The fund's expense ratio of 0.35% is higher than SCHD's, but this is expected for an actively managed fund with a complex options strategy. Determining the less risky option is straightforward. SCHD is the clear winner here. While both funds carry risks inherent to stock investing, SCHD's balanced approach, lower volatility, and straightforward strategy make it the much safer play for most investors. JEPQ's complexity and capped upside potential introduce risks that many investors don't fully appreciate until they experience them firsthand. Tax efficiency is a critical factor that many investors overlook, but it can significantly impact your after-tax returns, especially in taxable accounts. SCHD pays out qualified dividends, which receive preferential tax treatment by being taxed as capital gains rather than ordinary income. This distinction is huge for your wallet. Under the 2025 tax brackets, if you're married and earn up to $96,700, you'll pay 0% tax on qualified dividends. For income between $96,700 and $600,000, the rate is only 15%. Even at the highest income levels, qualified dividends are taxed at a maximum of 20%, which is substantially lower than ordinary income tax rates. These tax advantages make SCHD's dividends significantly more valuable on an after-tax basis. JEPQ operates differently due to how it generates income through its covered call strategy. Instead of directly selling call options, JEPQ packages them into equity-linked notes or ELNs. While this structure allows the fund to pass through option premiums as dividends, these distributions are taxed as ordinary income at your regular tax rate. Looking at the 2025 income tax brackets, ordinary income rates start at 10% for the lowest bracket and can reach 37% for high earners. This difference in tax treatment is night and day compared to qualified dividends, and it significantly reduces the after-tax value of JEPQ's high yield. For this reason, JEPQ is much better suited for tax-advantaged accounts like IRAs or 401ks, where you won't face immediate tax consequences on the distributions. While both ETFs are best held in tax-advantaged accounts to maximize their benefits, SCHD's qualified dividend status makes it much more tax-efficient for taxable accounts. This tax efficiency advantage gives SCHD a clear victory in this category, and it's a factor that becomes more important as your income and tax bracket increase. Performance comparison reveals an interesting dynamic that highlights the fundamental difference between these two strategies. SCHD has delivered annualized returns of around 12% over the last 5 years and approximately 10.5% over the last 10 years when combining price appreciation and dividends. These are solid, steady returns that reflect the fund's focus on quality dividend-paying companies. However, SCHD has faced some headwinds in recent times, particularly because two of its largest sector allocations, energy and healthcare, haven't been the market's darlings over the past year. But this short-term underperformance shouldn't overshadow the bigger picture of consistent, long-term wealth building that SCHD has delivered for over a decade. JEPQ's performance story is shorter, but impressive for what it represents. Since its inception in May 2022, The fund has generated annualized returns of around 13% when combining price appreciation and dividend distributions. This is particularly noteworthy because JEPQ has managed to outpace more traditional dividend funds while providing that high monthly income stream. However, it's crucial to remember that JEPQ is still a relatively new fund, and its performance period includes both favorable and challenging market conditions for growth stocks. The real test will be how JEPQ performs over a full market cycle, including extended periods of growth stock underperformance. In terms of pure numbers, JEPQ takes this category with its higher total returns since inception. However, this comes with important caveats about the fund's short track record and the inherent limitations of its covered call strategy during strong bull markets. SCHD offers the reliability of over a decade of proven performance, while JEPQ offers the promise of continued strong returns, but with less historical evidence to support that expectation. After analyzing all 5 categories, let's tally up the scorecard. SCHD wins in diversification, risk management, and tax efficiency, while JEPQ takes the victory in dividend income and total returns. That gives SCHD 3 categories to JEPQ's 2, but here's the truth that every investor needs to understand. This isn't really about winners and losers. It's about finding the right fit for your specific financial situation and goals. The real decision framework comes down to what type of investor you are and what you're trying to achieve. SCHD is perfectly suited for long-term wealth builders who want steady dividend growth combined with capital appreciation. If you're in your 30s, 40s, or 50s and building wealth for retirement, SCHD's combination of dividend growth, tax efficiency, and lower volatility makes it an excellent core holding. It's also ideal for investors who want diversification across multiple sectors and those who prefer the simplicity of a passive, rules-based approach. Additionally, if you're investing in taxable accounts, SCHD's qualified dividend status provides significant tax advantages that compound over time. JEPQ, on the other hand, is designed for income-focused investors who need cash flow today rather than tomorrow. If you're retired or nearing retirement and need monthly income to cover expenses, JEPQ's 11.5% yield distributed monthly is incredibly attractive. The fund works best for investors who can hold it in tax-advantaged accounts to avoid the tax drag of ordinary income treatment. JEPQ also appeals to investors who are comfortable with the complexity and risks of covered call strategies and understand that they're trading potential upside for current income. But here's where it gets really interesting. There's no rule that says you have to choose just one. Many sophisticated investors use both ETFs in their portfolios, allocating perhaps 60% to SCHD for long-term growth and stability, and 40% to JEPQ for current income generation. This hybrid approach allows you to capture the benefits of both strategies while mitigating some of the drawbacks of each individual fund. If this breakdown helped you choose between SCHD and JEPQ, smash that like button, subscribe for more ETF battles, and drop a comment telling me which fund made it into your portfolio. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.